Hey guys, welcome back to Click Capital, your go-to channel for the latest market analysis and charts. I'm going to share with you my insights from 20 years of trading for myself and clients. If you're watching the channel yesterday, you knew I came in today 100% net short. Stay to the end. I'll let you know how I'm positioned going into this week. So another interesting day in the markets. A lot happening out there across all categories with volatility and bonds. But first, let's get into the heat map as always and see what's been going on. So financials got slammed again today. JP Morgan was down almost 5%. Energy got hit really hard. Energy stocks are rising, so that came off really hard and it's broken down a support line on oil. Industrials got hit hard as well, but we did see defensive and utilities hold up pretty good. REITs had a little bounce, and mega cap tech is becoming the new defensive play in this market with lower rates. Economic data. PPI came in a bit weaker than expected, so that is good on the inflation front. Retail sales came in a little bit worse than expected month over month, but a bit higher year over year. And crude oil stocks much higher than expected, so we saw oil come off with that. Fear and greed still an extreme fear. So even though the market's not off that much because the SP500 is distorted by mega cap tech, there's still understandably a lot of fear out there and headline risk. Options, still got the banks being heavily traded. Bank of America at the fourth most traded today. And we're seeing other ones like Credit Suisse, which I'll get to in a bit. It was a big story today. And Citigroup, First Republic, all showing up there. Dark pools actually bounced back. So they've been showing a bit of sign of buying the dip here. And interestingly enough, we actually saw yesterday corporate insiders make more purchases than sales for the first time in quite some time. So that's quite interesting because we did see at the start of the month record sales, and now they appear to be buying this dip. So I can imagine some of those regional banks, and like we saw Charles Schwab CEO buy the dip 50,000 shares. So that's pretty interesting to see that. And over to Fed Fund futures probabilities, yesterday we're 78% of a hike, now it's 54%, 21% of a pause, now it's 45%. So we're coming up to almost 50-50, whether we pause or we hike. So we saw that inflation data coming a little bit better today. It's making the case for more of a pause. And what's happening with Credit Suisse and Europe, looks like the tide's gone out and we're seeing who's been swimming naked, and there's cracks showing up in the system. So we'll get to that in a bit as well. It's an interesting development. So Credit Suisse, another all-time low. The European banks just can't seem to get it out of the mess that they've been in for what seems forever now. Their biggest backer, the Saudi National Bank, said it won't provide any more financial help for them. It's kind of just letting them slide. And the Swiss central bank is stepping in to try and backstop it. All sorts of mess going on over there, as has always been the case, it seems. Ukraine. Moscow says it's going to try and retrieve the US drone that it shot down. And of course they're blaming it on the US and saying that they came into one of their airspace when it's not. So there's rules, and then there's the Russian rules, and I just can't see how this is going to not reach a boiling point, because both sides are not going to back down. The West can't back down. They can't let Russia win because it sets a dangerous precedent for China and Taiwan. And Putin's not going to back down. Putin's never going to walk away and say, "Yeah, you know what, West, you won. Sorry, we'll retreat." So this has got to boil over at some point into something, or at least we keep risking a potential accident or mistake that could cause things to boil over. But yeah, this is definitely a risk for the markets here, for sure. Goldman Sachs cuts their GDP forecast because of stress on small banks. They believe a pullback in lending will lead to a substantial tightening in bank lending standards, dragging down growth already affected by tightening in recent quarters. So that's a good point. This could we may have seen the top in rates. This could be the pivotal moment. If J pauses and that's it, and stability becomes a priority over inflation, and inflation might actually pull back if we see banks not lending as much, and maybe the financial sector laying off a few more staff. We see an unemployment tick up and just a contraction in credit growth. That could bring forward the recession and bring forward the end of this hiking cycle, which has been historic in its pace. Good to see today, SEC and Justice Department are investigating Silicon Valley Bank's collapse, including insider stock sales. So they had planned these sales, but I'm pretty sure these CEOs saw what was coming. Locking in rates at 1.5, 1.6, 1.7 on a $200 billion asset book without hedging. They knew what their risks were, and these guys, the CEO and CFO, cashed in big time, selling tens of millions of stock. And so hopefully we see some criminal charges, or at least pull back all their compensation and insider stock sales, drag them through the courts for months and years, and make a real example out of them. Would be good to see. And hopefully some real justice and punishment is seen here, because they can't just walk away from this and go on to their next gig, risking other people's money. So there's nothing wrong with risk taking as long as you have to pay the consequences if you're wrong. It's the whole risking everyone else's life and then getting paid tens of millions with no consequence. That's the problem here. So I think everyone's starting to realize this, and the government's going to go after them, which is good to see. Ray Dalio created the biggest hedge fund in the world and has a popular LinkedIn page where he often shares his thoughts. And he just wrote an article what he thinks about the Silicon Valley Bank situation. And Ray Dalio he's a brilliant mind. He's studied a lot of his hedge funds. He studied a lot of macro data and studied previous empires and credit cycles, debt cycles, going throughout all of history, to put it all into context. And basically, instead of reading all this, I just got ChatGPT to summarize it for me. So I just asked ChatGPT, said summarize the following text into several key points, and I pasted his whole article. So the summary was, Ray believes the recent bank failure is the beginning of a contraction phase in the short-term credit debt cycle. This contraction phase will lead to a domino falling-like contagion process, which will result in forced sales of assets, equity dilution, attractive acquisition prices for strong companies, and eventually the Fed easing and bank regulators providing money, credit, and guarantees. Furthermore, he believes the US central government has large outstanding debts and is selling more debt than there is demand for, and central banks are monetizing the debt. Ray warns the really big problem will come when there's too much money printing, which will lead to the supply of government debt being much larger than demand for it, causing too high real interest rates for the markets. So we may have seen the top in the rates, and it looks like Jay has broken something. Well, I don't put the fault on Jay. I put the fault on the insiders at Silicon Valley Bank. If they hedged their book properly, we wouldn't be in this mess. So now the Fed's in a super tight spot, with inflation still out there, but now instability coming to the forefront. That needs to be addressed and can't be exacerbated. So that's a big problem. But anyway, let's get back to the charts and look at price action. We'll come back to the indices today. Saw tech outperform. NASDAQ now above its 50-bar VWAP on volume. Mids came off the worst at 2%, but put in a hammer formation. We'll come back to this as we always do. Let's just take a quick look at internationals. Canada, England, Germany, Japan's been hit hard the last few days. Australia and China. Volatility today. Look at VIX 9-day. VIX actually shot up just under 30 and pulled back. But you can see we didn't take out Monday's high. But if you look at VIX 3-month, we did, and same with 6 months. So this is the market telling us that volatility is going to stay elevated for longer. We now have VIX 3-month and 6-month higher than VIX 30-day, even though we've got a Fed meeting next week. So this is kind of like the market going into a new regime, like saying this volatility is going to last. We're not going back back down here anytime soon. So going forward, you can expect stock prices to stay volatile for the next several months at least. So that's interesting to see that curve kind of flatten out now and go back towards a U shape. Volatility also broke out today as well. So things are still very fluid out there and moving a lot. Move index still really elevated at 169. Bond market volatility is huge. Not many puts being bought today though, around flat put call ratio. Breadth, we got that pop up on the 20-day, 20% of stocks above their 20-day average, but still weak structurally on the stocks above their 200-day average. Spreads, so this is interesting. We've got the discretionary tech industrials versus health, utilities and staples coming off a bit now under their 50 bar. Equal weight SP 500 just getting smashed versus the SP 500 dominated by mega cap tech. High beta coming off versus low volatility. But look at this, growth versus value breaking out today big time. Gap held, finished on the highs, new high for the year. This trade is back on. Same with tech versus SP. So just like in COVID, mega cap tech looks to be the hiding spot. These big cash cows, tech companies seem to be weathering the storm the best again. And based on that, we, in our client equity long short portfolios, we significantly reduced our short tech exposure, because this is not a trend we want to fight. Now we're in a new, suddenly changed environment with lower rates and financial instability in the financial sector. So that is an important trend to pay attention to. And this trade looks to be definitely on, because we were watching this here for a few weeks saying, oh, is this a top, maybe an island reversal? But it turns out it is a continuation pattern with what's changed. Yield curve holding on its bounce back up here, and high yield versus treasuries still showing a lot of stress in the markets with credit spreads and tight financial conditions out there. Over to the 2-year, that got down today down to 3.72. So the rates are still coming off, still a rotation going on in flight to safety. We can see the 10-year came off as well. Fed fund futures smashed down again today, new lows with that inflation data in Credit Suisse. September got down to 366. It's unbelievable. It was last week we're up at 568. The market was saying what rates are going to be in September. Today 366. So this is some of the biggest moves we've seen in rates since the 1987 crash going on right now in the bond market, and across the world too. We've seen rates come off in UK, Europe, Japan, and we can see here that flight to safety and treasuries up almost 2% today. And if we just zoom out to a monthly chart, so treasury's been getting sold off since that COVID high with that flight to safety there, and with the increase in rates. But we may have seen the top in rates. As crazy as that to say, as last week we were just humming along higher and higher, no end in sight. Now it looks like we may have possibly put a top in rates, and if that's the case, TLT could become a good position here going forward, being down the bottom of its range. If we do a Fibonacci from its last move up from the start of the bear market in equities, 50% retracement takes us around that 123.70 mark. So if things continue to go bad, this is pain at the moment at yield 2.6, 2.7. This could go further, especially we see if J does pause and if there's more headline risk, and then who knows, maybe 2-3 months from now we even get a cut. This could be a good asset to be in going forward, especially as a diversifier. And same possibly with investment grade debt as well. And if we look at the price action in investment grade, we actually got above our 50 bar today. So the market's not too worried on the credit quality of AAA listed companies. Bit high yield. We actually made a new low today. So there's still some worries about the riskier end of the market here. So that was interesting to look at. The dollar shot up today. Even though we had rates off heaps, dollar shot up, big move up, bit of flight to safety. But I also think that's got to do with Credit Suisse because we saw the euro come off hard as well. So I think there was a bit of a flight out of Europe into dollars with the mess in Europe as well. Yen just kind of holding there. Bitcoin kind of just sitting at the top of its range. We go out to a weekly on the Bitcoin. We've got this resistance zone around that 25,000 mark. So that's kind of this key zone that we need to push through on Bitcoin for us to break out to new highs. But given what's happening in the banking sector and people really worried about credit risk now, third-party risk, there is definitely reason for Bitcoin to take off here. We can see that volume coming in the price action. Even though we did put in a bit of a shooting star there yesterday, let's see if that can confirm lower back below its 50 bar. Otherwise, we may take out that, and that could be a powerful breakout there in Bitcoin. But that's hard to say with cryptos, as always. Commodities fell through their support zone. We've been watching here for a while. So let's just take that log chart off. I had been thinking commodities would hold here. But we're in a new environment. A lot's happened in the last week. And with that climbing dollar and weaker forecast economic growth, commodities have fell through the support zone that we've had for quite some time. And we can see on Dr. Copper as well. He had a pretty big down move today. Finished down 3.2%. And that's gapped down and finished below its open. So copper being used in many products and industries is a good leading indicator of upcoming economic growth, and that is rolling over now. Over to gold. Gold actually got up to new highs today. Even though we saw the dollar increase, which is normally a negative for gold, I think there's still a bit of flight and safety in gold here, because once again, if you hold it or someone really trustworthy holds it for you, then there's very little third-party credit risk in it. And with inflation still persistent and now the real chance that rates may pause or go down, there's a good bullish case to be made for gold here, and that price action is showing as such as well, with new high and high low today. So I'm bullish gold here, and I've got a bunch of gold stocks on my watch list. Silver, a little bit of the same story as well. And oil's broken down from its support as well with the increase in oil stocks. So oil inventories. So that's not looking good for oil, and that's probably a bit of weaker forecast economic growth in that as well. Over to stock sectors. Let's just go through each of them and just get a bit of a view of where we are in relation to the 50 bar VWAP. So there's the IPO. IPO sector's kind of dead at the moment. ARC's still looking a bit broken. Same with clean energy. Tech above its 50 bar VWAP. That's the hideout spot at the moment. Discretionary. Semis kind of just holding there, consolidating. Bit of indecision there in the price action in semis. This could go either way here. Bots just holding. Communications. Look at that price action. This is with Meta in this. But there's some strong volume on that there. Retail. Just down the bottom of its buy-sell band. We put in a green candle on volume. Biotech just holding there. Energy got slammed today. Oil and gas. Materials came off as well with commodities. Bit gold miners, the exception. Financials, lower high, lower low. Did manage to hold on a little spinning hammer. Regionals, down the bottom of its range, extremely oversold, 25% below the 50 bar. Industrials got hit hard, but then reversed and hold, put in a hammer. Transport's holding down there. Real estate as well. Home builders just come off on a bit of a spinner. Jets sold off hard. Defensive, big kind of hammer. And here we've got healthcare holding. Staples almost above its 50 bar. And utilities now above its 50 bar VWAP. So in this market where there is a bit of a rotation flight to safety, we've got mega cap tech, treasuries, Bitcoin, gold, utilities. that's where big money's been flocking to. And it's been getting out of the cyclical stuff, industrials, discretionary, energy, and of course financials. So that's a bit of an interesting theme we've got going on in the market that could potentially continue for months. So this could be the start of a new rotation that goes on for months. Popular stocks, BlackRock actually made a new lower low today. So BlackRock's what I call the BlackRock barometer, because their business is dependent on fund flows into the stock market, into their index funds. So that has been really weak price action of late. And JP Morgan, even though we'd been seeing that hold up the best out of all the financials, with a lot of deposits being wired into JP Morgan being the largest too big to fail bank, actually came off hard today, almost 5% on volume, made a new low. So the storms, clouds are still out there for financials. We are not in the clear just yet. Mega cap tech, Apple wasn't up that much, but look at the price action in Microsoft. Well above its 50 bar, strong volume, finishing near its highs. Amazon starting to look good. Google had a really good day, 2.2%. Meta actually just broke out to new highs since the almost middle of last year at new yearly highs. We took out this earning gaps high today on Meta, and finished basically on its high as well. So bullish price action there for Meta indeed. Same with AMD, broke out. Nvidia didn't break out, but with this price action, I would expect it to tomorrow, if not the day after. The question is it going to be a fake out or a breakout? This AI hype train could still go further, but we're still short it because on valuation and being technically overbought. But we do have a stop in place because this thing could still rip to 300. But if things do turn in it, it could turn really quick and really hard because there is a lot of people long, and there's a lot of people on this AI hype train. And once we go below the 50 bar VWAP, then things could accelerate to the downside once all these longs bail out on the position, if that were to happen. Netflix had a nice turn today, but it's been trickling down, struggling to find a bottom. Netflix was up 3% today, and Tesla was just off a little bit, 1.5%, and kind of a bit of indecision. And that's kind of what I think it's going to be going forward, barring any big move in the market. There's going to be a lot of indecision around the 50 bar VWAP, I think, for Tesla. Moving over to meme stocks, we had Coinbase up a little bit today. AMC slammed again today, almost near new lows. Same with GameStop. And look at all these meme stocks just getting completely trashed. Bed Bath Beyond now $1 stock. It was last month we got up to 7. Carvana on life support. Big Bear new lows again. AI new lows. Robinhood, Snap. All these things are kind of just on life support. Credit Suisse. Look at this thing. Let's go out to a 3-month chart. Gosh, look at this. Nothing but down since the GFC. This thing, and like I said, when this gets beaten up this bad, technically speaking, price action is kind of just structurally dead or a zombie at best. So I doubt this thing will come back and hit the 20s or 30s anytime soon. The Europeans just can't seem to sort out their banks. So just what a complete mess they've got going on over there. Banks. Bank of America kind of just held there a bit. I think we're close to putting in some sort of bottom here on the banks, barring any new, like there is of course a lot of headline risk. If some other big bank comes out and they're in trouble, then we're going to make new lows, whether in America or overseas. So otherwise they look to be putting in a bottom. I'd say there's some value buyers coming in, maybe some insiders as well with all this volume on the banks, Citigroup and Wells down here. So we know these companies are too big to fail. The government will always backstop them. They shouldn't have a flight on deposits. They should actually benefit from the flight of deposits from regionals into the big five. So they are deeply oversold here and trying to put in a bottom, barring any new unforeseen big headline come out. But the regionals, I mean, who knows? Even on these really hard ones, Truist, First Horizon, this thing is, technically speaking, is broken. I wouldn't touch this with a 10-foot pole. you got better luck at the roulette wheel in Vegas, in my opinion, on these things right here. I mean, sure, they could turn out to be good buys here, but who knows? They could turn into zombies, just backstopped by the Fed, but all customers and investors lost interest, especially when it's the equity holders are at risk. It's not the deposits. You've got a messy Fed backstop if you've got a deposit, but equity holders, they're the ones wearing the risk. So look at the Key Corp and Western Alliance, just crazy volatility in this name. First Republic was down 21% today. So I'm avoiding these regionals. I did got a bounce in Schwab, but I was out of that yesterday. And I'm kind of steering clear of the regional banks and kind of overall the sector as well. I don't plan on getting into it for some time. PacWest, Schwab actually held on up 5% today. So that was really good of the CEO to come out and buy 50,000 shares. Actually putting his money where his mouth is, unlike the Silicon Valley banks that were just dumping stock to public while trying to talk it up. Okay, so that's a bird's eye view at all the major markets and asset categories today. So where are we at on SPX? 38.91. Let's turn on the global net liquidity model. 38.41. So the central banks are going to be providing liquidity. So they will support this and artificially inflate it as they have been doing since the GFC. We turn on our market risk on-off indicator. This looks at a bunch of things, breadth, fixed term structure, price action. That's actually still risk on, unbelievably. So the market, it looks to be trying to put in a bottom here. We look at even on the equal weight, SP500. That's a hammer candle formation on big volume in a really oversold state. And the market's still trading in this kind of range. We can see our range strength here. And the Qs are above their 50 bar VWAP. So that's technically an uptrend. And then you can see in our trend candles, so NASDAQ is in a technical uptrend, believe it or not, with all this mess going on. Dow's there oversold as well, putting in big volume, mid caps and small caps as well. That's got the regionals in them. So this market is the price action here on this volume and a deep oversold with all these hammer formations is trying to put in a technical bottom here. But like I said, we've got big headline risk. If another big bank comes out, they're failing and there's more contagion and et cetera, et cetera. I mean, we do have an elevated volatility environment. But if things were to calm down, I suspect we're going to get a pretty good bounce here. Especially, the NASDAQ's in an uptrend and the SPY and the others are trying to hold on and put in a bottom here. So once again, a tricky market, a dangerous market, vulnerable to a rug pull at any moment. I came in 100% net short and I balanced out somewhat today, took some profits on shorts and added a few little longs here. But I'm still 20% net short going forward. I don't want to get net long just yet. But once again, the market had a chance to do its flush and do its dive, and this just by the dip action just has been the trend all year. It's just constantly being bought and supported. Has every reason to completely fall off with volatility. Bond market volatility now at GFC levels, biggest bank failures since GFC, and the SP 500 just can't sell off. So it's well supported here. And now with maybe we've seen the top in the rates, the stock market's going to get pretty excited with that, the pressure coming off. But that might bring forward the recession as well. So a lot of mixed signals, and I think barring any unforeseen big headline, we're going to see a pretty good bounce here. So that's why I'm close to being market neutral. But of course, this is a super fluid situation, and every day brings new data and new price action. So we just got to play it by ear and day by day. But that's all I've got for you today. Thanks very much for tuning in again today. Take care out there, and we'll see you again tomorrow.